Hi, my name is Liz Schlemer, and this is a video for IME 315, Financial Decision Making for Engineers at Cal Poly San Luis Obispo. This particular video is about income statements. Now, there's 5 areas that we are covering in this class, and they are listed right here. This video falls into the category of reporting and managing profits. Now, there's ways of reporting that are standard in all companies, and these 4 accounting reports are what you often can see when you're looking at the financial records of a company. There's other videos that cover balance sheet and statement of cash flow, but this particular video we're going to be looking at income statements. Income statements also go by other names like net earnings statement, statement of operation, and it might have the word consolidated in there. I often refer to it as an income statement or a net earnings statement. So we're going to look at the details of an income statement. This is a very simple income statement, but most companies that you're going to be looking at will have much more complex, but many of the items are going to be consistent through the income statement. So the first thing that you will usually see is revenue or sales. Now, in the simplest form, it's the volume that you're selling times the price. So in this case, we're selling 1,000 units at $10 per unit. Now, of course, companies usually sell more than one type of units. So this particular revenue would be summed across all types of units and to get the total revenue. And again, a thing I didn't mention is the income statement is for a period. So in this case, I have this for the year ending December 31st, 2018. It could also be for a month or a quarter, but it is for a particular period. Now, this is in contrast to the balance sheet, which is a snapshot in time. So it's important to remember the differences between the income statement is for a period, balance sheet is for a snapshot in time. So we continue on to look at the next line, which is cost of goods sold. And this is also simply the volume that you sold times the cost per unit. So in this case, we have units of 1,000 units times $4 a unit. Now, it could be cost of raw materials, and sometimes it also includes the cost of direct labor. And we'll talk a little bit about the different types of costs and calculations in a different video, but in this case it's the cost of goods sold, which is the raw materials, times the units sold. And then gross margin is just the difference between revenue and cost of goods sold. So often cost of goods sold is abbreviated in COGS to indicate that that's the cost of goods sold. So the next thing then that we're going to look at is operating expense. These are what's often thought of as fixed expenses. So these are fixed over a particular time period. They don't vary with the number of units you sell. Where raw material, obviously, the more you sell, the higher cost. But things like rent, insurance, some kind of labor, and any other kind of support activity will be constant over the period, and those are known as operating expense. There's other kinds of fixed costs that sometimes fall into this category, like selling, general, and administrative expenses. You'll often see that category, but I just lumped them all into operating expense. The next thing we'll look at is pre-tax income, which is gross margin minus operating expense. You can see it's 6,000 minus 2,000 is 4,000. The next category then is taxes, because we often want to know how much money a company actually gets to keep, and taxes are the portion that you have to pay to the government. So in this case, it's just the pre-tax income times the tax rate. So I have 4,000 times a 25% tax rate is $1,000. And then the last thing is net income, which is pre-tax income minus taxes. So you can see how this calculation goes, and you can practice this in your homework assignment. So when we look at some of the things associated with the income statement, we want to calculate some kinds of ratios so we can compare one company to another. One of the things we often do is take net income as a percent of sales. So sales and revenue are often used interchangeably. So in this case, we want to look at net income divided by sales times 100 to put it in a percentage. For our calculation here, it would be 3,000 over 10,000 or 30%. So this is net income, and as a percent of sales is 30%, which is actually pretty good. That means that every dollar we sell, we get to keep 30 cents of it, and that's quite a good margin. So as we looked at this video, we were covering aspects of reporting and managing profits.